Hey there, Jorge Montoya with the Montoya Mortgage Team, and today we're going to talk about conventional financing. So having said that, let's get started. So first, let's start by answering the question, what is a conventional loan? Well, a mortgage loan that is not insured or guaranteed by the government is a conventional loan. Now, there's two major agencies. One is Fannie Mae, which is short for Federal National Mortgage Association, while the other one is known as Freddie Mac, which is short for Federal Home Loan Mortgage Corporation. Now, these two agencies are government-backed but privately held mortgage companies that buy and guarantee mortgages. Now, the main difference between the two is that Fannie Mae tends to buy loans from much larger banks versus Freddie Mac, who buys loans from smaller banks. Now, when it comes to down payment and closing costs, there's a few unique things that we're going to take a look at right now. And the down payment ultimately is dependent on whether you're going to occupy the property or not. So let's start with owner occupancy. If you're purchasing a property and it's a one-unit property, like a condo or a manufactured home or just your traditional single-family residence, the minimum down payment can be anywhere between 3% and 5% down. Now, conventional financing does have a 3% down payment option if you meet the area's median income. But if you make above that median income, then that's when now 5% becomes the minimum down payment. Now, when it comes to multiple units, now let's take a look at maybe a duplex, 2 units. The down payment, even though you're going to occupy, does go up quite a bit and now becomes 15% down because it's more than 1 unit. And they will actually allow you to finance up to 3 to 4 units. So if you're going to buy a triplex or a fourplex and you're still going to occupy one and maybe rent out the others, this is allowed, but the down payment increases again to 25% down. So if you're trying to get the minimum down payment on an owner-occupied property, you want to go with a 1 unit property. Now, there are different types of occupancy, such as a vacation or second home. So for example, we live in Reno, Nevada. Here's where I'm filming, and we've got South Lake Tahoe that is about an hour away from here. And that is a vacation area. You've got skiing, you've got swimming, you've got hiking. So it's very common for somebody from Reno to go buy a second vacation home over there in Tahoe. And when it comes to second homes, vacation homes, there is a requirement that it must be a 1 unit property. This cannot be an income producing property. And then as long as it is a 1 unit property, the minimum down payment is 10% down. Now, the last type of occupancy is an investment property. So if you're one of those families that already owns a home and you want to build a real estate portfolio, conventional financing is a great way of doing it. And one way of doing it is just to buy a 1 unit investment property, a traditional single family home, and the minimum down payment there would be 20%. Now, they will allow you to finance 2 to 4 units. But when it comes again to occupancy, it being an investment property, the down payment is going to go up to 25% because it's multiple units. But still a very good tool if you're one of those families looking to build a real estate portfolio. Now, let's talk about credit scores. Now, the minimum credit score with a conventional loan is 620. However, conventional is very specific when it comes to credit scores. So in general, the sweet spot to get a decent or better deal is to be at 680 credit score and above. So the program does let you go down as low as 620. However, when it comes to the interest rates and the mortgage insurance, your credit score plays a big factor. And when we analyze your options, we found that about a 680 credit score tends to give you the more favorable terms versus being below a 680 credit score. And I'll elaborate further on how that impacts your credit score and the mortgage insurance. But 680 is the minimum score. Now let's talk about negative credit events. One negative credit event might be a Chapter 7 bankruptcy. And when it comes to that, conventional financing may still be an option for you as long as it's been 4 years from the discharge date. There's also Chapter 13 bankruptcies, which is when you make payment arrangement with the creditors. And that does require a 2-year period from the discharge date. Now, one thing that makes conventional really unique and a little bit more strict when it comes to negative credit events is if you have multiple bankruptcy filings. So for example, if you have multiple bankruptcy filings in the last 5 years, if you have multiple bankruptcy filings, they are going to ask you to wait 5 years from the discharge date if you have more than one filing in the last 7 years. So that is something unique that conventional does that FHA loans and VA loans do not. When it comes to foreclosures, conventional financing is going to have the longest waiting requirement as opposed to a VA loan and a conventional loan. So when somebody goes through a foreclosure, there is a 7-year waiting period from the completion date of that foreclosed property. There's also deed in lieu and short sales. So a deed in lieu is when someone was not able to make their monthly payments, so then rather than getting foreclosed on, they voluntarily signed over the deed back to the bank, and that's one negative credit event. The other is a short sale, which is when someone may owe $400,000 on the home, but now the home may only be worth $200,000, and they're trying to sell it at the lower amount and asking the bank to forgive the difference. So if you are one of those families, then there is a 4-year waiting period from the completion of the short sale or from the completion of the deed in lieu of the foreclosure. When it comes to interest rates, this is what really makes a big difference between conventional loans, government loans, and such as FHA and VA, because conventional pays a lot of attention to your credit score. So generally you can get a 30, a 20, a 15-year fixed loan. And for example, with the company I work with, if you wanted to get a modified term, like let's say you wanted to get a 25-year term, we can actually do that. So you're not just limited to 30, 20, or 15. However, there are also other options such as adjustable rate mortgages, which is something that you're starting to see more in rising interest rates environments. But of course, that comes with a different risk. But when it comes to the interest rates, if you want to get the best rate possible, the best payment possible on both your interest rate and mortgage insurance, you want to have a 740 credit score. And that's why on one of the prior slides, I said the sweet spot for someone to lean towards conventional versus a government loan is that 680 credit score, because that's when we start noticing that you start getting lower fees, lower interest rates when it comes to conventional financing. But a 740, you're going to get the best that is available anywhere. Conventional loans also allow what's called temporary interest rate buydowns, which in rising interest rates environments, such as the environment we're in now, becomes a very attractive tool. So for example, if the going rate was 7% and you got a 3-2-1 interest rate buydown, then your interest rate and your monthly payments won't start at 7%. You'll actually start at 4% for year 1, and then 5% for year 2, then 6% for year 3, and then year 4 through the rest of the 30 years, you'll be back at the 7%. So this becomes a really attractive tool for home buyers because it allows you 2 to 3 years worth of payment relief while the dust settles and eventually interest rates come down, because they do. Markets are cyclical, and we just happen to be in a rising interest rate environment. Now, when it comes to mortgage insurance, I mentioned a few moments ago that conventional financing is unique in the sense that both your interest rate and the monthly mortgage insurance amount that you pay is heavily dependent on your credit score, as opposed to FHA financing. So with an FHA loan, everybody gets to pay the same monthly mortgage amount, assuming you're borrowing the same amount. But with conventional financing, it completely depends on your loan to value. So the smaller your down payment you give versus, let's say somebody gives 3% down versus someone that gives 10% down, the person that gives 10% down is going to get a little bit of a cheaper mortgage insurance premium versus the person that gave the smaller down payment, because it represents a positive risk factor that you gave more. And then same goes with the credit score. Someone that has a 680 credit score will get a decent rate. Someone that gets a 740 credit score, they're going to get the lowest mortgage insurance possible. Now, when it comes to mortgage insurance, there's 3 different ways that can be paid with conventional financing, which is really neat. So one, you can pay the traditional way, which is monthly. You pay your principal, your interest, your taxes, your insurance, and then you add the monthly mortgage insurance to complete your payment. There's also something called split premium, which is when you may prepay a certain portion of the mortgage insurance in order to get a reduced charge on your monthly mortgage payment. So that's one option that's pretty cool to give you lower payments. And then one of the other options is what's called a lump sum payment. So depending on your negotiation with the seller, sometimes you can negotiate to generate a large enough seller credit to have them prepay your mortgage insurance up front, which means that you get to buy your home with the 5% down, for example, and now not have to pay monthly mortgage insurance, which in the end equals lower payments for you, which is a good thing. One other thing with mortgage insurance is that it actually can be removed without refinancing. So this is one of the things that makes conventional financing very, very attractive, because with other financing types such as FHA, generally you need to refinance in order to remove the mortgage insurance. But with conventional financing, if you've paid, say, 24 months and now you've got 20% equity or more, and let's say interest rates are higher than what your current market rate is that you have on your current loan, you could start a process called self-initiated mortgage insurance removal, which is when you apply to remove the mortgage insurance through the process of an appraisal to justify that you now have the equity, which means you get to remove the mortgage insurance, which equals lower payments, but you get to keep the existing interest rate, which in today's market, that's a really, really good thing. Now, when it comes to property types, there are some property types that are allowed for conventional financing. So like we mentioned in the beginning, 1 to 4 units are allowed. So a single family, a duplex, a triplex, a fourplex. That's where it caps out. The minute you go into 5, 6 units, that's now no longer considered traditional mortgage financing. Now that's more commercial type of financing. But as long as it's 1 to 4 units, you can count on conventional financing. Condominiums also tend to be a very good option for conventional financing, and it also does allow for the purchase of manufactured homes. However, on manufactured homes, it's got to be your primary residence or a second vacation home. So now let's talk about the loan limits. So every year, conventional financing analyzes the marketplace, and then depending on what they see, they will either increase or decrease the loan limits. And in the last couple of years, we've seen consistent increases. So the loan limits I have here are the unofficial loan limits, because we've already preemptively increased them because we believe that Fannie Mae will end up increasing them here come the end of the year. So for a 1-unit property, you can finance up to $700,000 with a conventional conforming loan. For 2 units, you've got $895,000. 3 units, $1,080,000, and 4 units up to $1,356,000 is the current maximum loan limits. Now, come 2023, we will see what those new loan limits are, and of course, we will keep you posted and give you that information. When it comes to appraisals, appraisals are generally required when you do conventional financing. However, in the last 2 years, we started seeing more and more what's called an appraisal waiver, because home values, depending on how much, as we've seen home values increase quite a bit, and then depending on the overall credit profile of the buyer, the down payment, the debt ratio, it has been more common to see the underwriting systems give you the option to not complete an appraisal. And all that means is that they, based on their electronic data that they were able to research, they believe that the value entered into the system is the justifiable value. However, one thing to point out from a consumer standpoint, if you are one of those families that receives an appraisal waiver, the choice is yours. You can choose to waive the appraisal and then you move forward with your purchase, accepting whatever that contract price is. However, even though you have the appraisal waiver, that doesn't mean you don't get to have one if you choose to have one. So if you want one completed, even though you have the waiver, you can definitely do so. But it's really up to you. When it comes to the appraisals, I will say conventional financing is going to be the most lenient on the property condition, especially when compared to an FHA loan and a VA loan. There are certain property standards that those government-backed loans require that sometimes conventional may become a better option because of the type of property and the property condition. So definitely a lot more leniency with conventional financing when it comes to the appraisal. Employment requirements are pretty similar with across the board with the financing type. So generally they want to see a 2-year employment history. So that's pretty traditional. You can use schooling as part of your employment history. So for example, if you're currently a registered nurse, but you went through nursing school for the last 2 years and you've only been on the job for 2 months, we can use the 2 years worth of schooling as part of your 2 year employment history and then still get you some mortgage financing even though you've been 2 months on the job. So that's really cool that we can combine that. But something really important when it comes to the schooling, it's got to be something that led to your career. So if you were going to school to become a teacher and then you started working at a bank as a bank teller or a personal banker, those two are not in the same line. It's not going to be counted towards your employment history. Now, sometimes less than 2 years employment history can be used. It really depends on the lender. So not all lenders are created the same. Some companies have more overlays versus others. So for example, overlays means that a conventional loan might require, let's say, a 620 credit score, as I explained a few moments ago. However, you go to ABC Mortgage, and they may have an overlay saying that they will only lend to people that have a 640 credit score or a 660 credit score for their conventional options. So the same goes with employment history. So we did have a client last year in 2021 that only had a year and 2 months worth of employment history. So when we underwrote the loan and we saw that there were other positive compensating factors and the income being earned now was being supported, then they did allow us to do less than a 2 year employment history. So that is case by case, and like I mentioned, really depends on the lending institution you're working with. Some will not consider less than 2 years. When it comes to the debt to income ratio, it can be up to 49.99% DTI with AUS approval. What AUS means is just the decision engine that we're using in order to qualify the loan. So as long as you get an approval on that decision engine, you can go with the higher debt to income ratios. However, like I mentioned a few moments ago, the debt to income ratio, also known as the DTI, can vary from lender to lender. We will allow you to go up to a 49.99% debt to income ratio, but other companies may be only able to let you go up to a 45% debt to income ratio. So this is where you might see one person qualify for $300,000 with one company and then $350,000 with another company. It could be because there is a lender overlay. When it comes to student loan debt, that is also factored in your debt to income ratios. And generally we use 1% of the balance if there is no established payment plan or if it's deferred. So 1% of whatever your current balance is what we'll use to add to the debt to income ratio. Now let's talk about seller contributions. So depending on the down payment you give determines how much a seller contribution is. Now to further elaborate, a seller contribution is when you go and you make your offer and then you ask for X amount of dollars as a credit back to you to help you get a lower interest rate, pay your closing costs, things like that. So for example, if you're giving less than 10% down, conventional financing is going to limit you to only 3% maximum seller credit based off of the sales price that you've offered. However, if you're giving 10% down or more, that max seller credit doubles, and now you can get up to a 6% seller credit towards your closing costs or interest rate buy downs, which becomes really fun because this is how now we can really tailor the loan and provide you with lower monthly payment options, which is great for you. Now let's talk about refinancing. So refinancing, at least at the moment, we're not seeing too much of it just because of where interest rates are, but here are some of the most common reasons people tend to refinance. So number one is to remove mortgage insurance. However, the good news for you, like I mentioned, is with conventional loans, you don't have to refinance to remove the mortgage insurance as long as you have the 20% equity. And it's called self-initiated mortgage insurance removal. However, markets change, so eventually rates go down and you may want to refinance then. Another reason to refinance is people will consider pulling cash out, whether it's for home renovations, pay off debt, or other investments. I've had a lot of clients want to buy just land, so they'll cash out to buy the land. Or maybe you've got a project in Mexico or wherever it is that you want to invest in. That's another common reason for people cashing out through a refinance. Another reason is to reduce the term of the loan.
Maybe you've got a 30-year loan and you love your house. You see yourself there forever and you want to pay that sucker off and you want to go to a 20 or a 15 or a 10-year loan. That becomes also another reason to refinance. And of course, one of the more common one is rate reductions. So anybody buying real estate in the year 2022, especially the second part of 2022, guaranteed you're going to refinance because you just purchased in a rising interest rate environment, and there's nothing wrong with that. You're getting a much better deal on the buy side. You're able to negotiate more now versus you were in 2021. But lowering your interest rate, we know that rates will go down, and then that becomes a reason to want to refinance your current mortgage. Now, let's talk about what a seller thinks when it comes to conventional financing. And conventional financing, their perception is that a conventional loan is a stronger buyer, which can be the case. But I will say, if you have a VA loan or FHA loan, those can also be strong buyers as well. And another thing that a seller thinks is less repairs, and that is true. Like I mentioned in prior slides, conventional appraisals tend to be a lot more lenient when it comes to the property condition. Now, how do we apply? Do I reach out to conventional, to Fannie Mae, Freddie Mac? Well, you do not. You apply through any lending institution like a bank, a credit union, or a mortgage company such as myself in order to see whether you fit the Fannie Mae guidelines or the Freddie Mac guidelines in order to get you your conventional financing.